Barb, I can't see you. Your video's not on. Hi, Becky. You have a video. If you could turn it on, that would be awesome. At least when we get started. Bethany, can you see the first? Like, does it say understanding 1003 or 1031?
Yeah.
Okay.
Yeah.
Cold this morning. It was so warm yesterday or the day before. Need it to be warm again.
Phoenix hit 100 on Wednesday, I think.
Are you serious?
Yep.
I mean, that just sounds so wonderful to me. I just want it to be warm.
I think we've only hit 90. But not terrible.
It's starting to flood a little bit here.
It's starting to what?
Flood.
Oh, I saw a video yesterday. It's up north though, right?
Ogden River. Then I've seen some TikToks from Salt Lake.
Hmm.
Lehigh says, the paper Lehigh was saying that it's gonna be okay, but we'll see. I don't know.
Aren't the waterways pretty far from Lehigh?
There's a bunch of canals that go through.
Mm.
There's one right by Lehigh Elementary.
Okay.
And we just got a bunch of people coming back in. Hi, Rachel.
Good morning, good morning.
Good morning. Hi, Joseph, Carla, hi.
Well, hello.
How are you?
So good. How are you doing?
Good, thanks. Just quick eating my breakfast while we're waiting for a couple more people to jump on.
Enjoy.
Yeah, it's not great. Just a bar. Carrie, you're eating too. I'm not the only one chewing.
I see you chewing too, and I'm chewing.
I know. I just finished. It's good to see you.
Good to
Okay, go ahead.
Good to see you.
No, thanks. Okay, everybody who, if you don't have a camera, that's fine, but if you do have a camera, the state requires that we have people turn their cameras on. During the class, I'll give 5 keywords. You need to send back 4 of them to me to get credit. So make sure you write down the keywords when I say them. I usually say them a few times. So if you're paying attention, you'll get all your words. And then that's really it. So you can send it to just my email address, ejohnson@securityhomemortgage.com when we're done with the class. But sometimes I forget to give the keywords. I get all going. Hi, Julie. And so if I forget, just have we had a keyword? Bethany's usually pretty good at keeping me on track that way. Okay, today I've kind of changed this class a little bit. Probably none of you have taken my class before because probably haven't been teaching it for 2 years yet, but I wanted to focus more on the 1031 exchange. I think that the last time I taught it, I felt like we focused more on real estate investing, and most real estate agents kind of understand the importance of real estate investing, and so I cut some of that out. Went to a training on 1031 exchanges and added some new slides. So I hope it's a good class today. Hopefully you learned something. And really, you don't have to know everything there is to know about 1031 exchanges, right? Because you're going to get them to a qualified intermediary, but you want to know the basics so that people aren't selling their houses before they meet with a qualified intermediary if they want to do a 1031 exchange. So just kind of knowing the basics, you'll be able to help your clients if they want to do the 1031 exchange. Make sure you have the addendum in there, all those things. So just real quick, we all know that it's a really good investment for real estate, right? That's what we want people to understand. It's not a good short-term investment. And right now, when I have people come to me and they're like, wait a minute, that's a lot more than my rent. I don't know if I want to buy a house. We want, I didn't give a keyword, Barb. We want to be able to help them understand how important it is to start owning instead of continuing to rent, even though there is a little bit of a sticker shock, especially right now when rates are higher. When they were down in the 2s and 3s, right, there wasn't quite as much of a sticker shock, but there is a little bit now. So if you're paying, $2,000 in rent, your payment's $3,000, there's a little bit of like, why would I do that? And so we need to know like how important it is to like for their future, financial future, to own a home instead of continuing to rent and make somebody else money. So there's a few quotes there. Basically, just a few things, advantages over time. We've always increased. There hasn't been a 10-year period in history where real estate hasn't appreciated. Long-term wealth, lots of people have made lots of money in real estate. People have lost money in real estate too. So there are some, things that we want to make sure that we protect people against. We want them to understand there's, if you own rental properties, there's going to be times when maybe you don't have renters. So you have to be prepared when you go into this business. It's not just, okay, buy a bunch of properties. You have to understand what you're getting into. Passive income, reduced taxes, depreciation, buy a property where you can vacation, Airbnb, second home. This is something that, and if you guys want this slide, I can send it to you, but it's really powerful when you're showing somebody who's trying to bite the bullet and rent being more expensive, over time, how much money they can have in equity versus how much their rent will increase. And so that's kind of a valuable thing. And if you guys want these slides, I can send them to you, but just being able to understand that it is always better in the long run to buy versus rent if you can. So I know there are some people right now who can't, and my heart bleeds for them. Like literally, I just feel so bad when they come to me and they make, $20 an hour and they can't buy a house and they've got $30,000 to put down and they still need a cosigner. So anyway, okay, 1031 exchanges, super cool idea, right? We know the basics of, well, let Jesus in. We kind of know the basics, right? You want to defer the taxes. And so the 1031 name comes from an Internal Revenue Code. So the Internal Revenue Code is section 1031. That's why it's called a 1031 exchange. The exchange of certain types of property may defer the recognition of capital gains or losses due upon sale, and hence defer any capital gains taxes otherwise due. So basically we're deferring. We're not saying you're never going to get taxed on it, but we continue to defer it. And they have that saying, the only way you can get out of paying taxes is if you die. And that's kind of the only way you can get out of paying taxes on your properties too, right? So a lot of people will keep them. When they pass away, they're inherited by their kids, and then their new basis goes up and they could sell it and not have to pay any capital gains because their basis is what it was when they died. So that's really the only way you get out of it, but they call it kind of kick the can or swap till you drop. I've heard people say, and you just keep swapping and you get a newer house, right? So that you're not having to deal with all the repairs, but then you don't have to pay those taxes. To qualify for section 1031 of the Internal Revenue Code, the properties exchanged must be held for productive use in a trade or business or for investments. Stocks and bonds are not eligible. real properties generally are of like kind regardless of whether the properties are improved or unimproved. So you could have an unimproved piece of land that you're exchanging for a house or vice versa. You can do commercial property for residential property. It doesn't have to be both residential property. Like kind is very general. So basically, if you just remember any kind of real estate, commercial or residential, you can trade for another piece of residential property or land in the continental United States or the 50 states, right? So there's a couple, somebody told me the other day that, you know, it says in some cases the Virgin Islands. So if you're outside of the actual United States, be careful. But you can't switch a property in the United States and defer the taxes and buy a property in, say, France. So that doesn't work. So foreign to foreign and what's the other word? Not foreign, but anyway, America to America.
Eden?
There's another word. What is it?
Eden, can I ask a quick question?
Please, and feel free to ask questions and just interrupt me. Go ahead, Kelly.
So, what if a client has a home here in Utah and would like to buy one in California? Would he, and he's owned it for only like a year? Because I know you pay like a lot of taxes if you don't stay in it, what, 2 years? And
Yeah,
if
so
he
that, yeah, so we're talking about two different things because if it's a primary residence, then we have the 2-year rule. But if it's an investment property, then there isn't actually an amount of time. We'll go into that a little bit later. There's not an amount of time, but typically we talk about it as like 1 year holding it. But if it makes sense, then sometimes you can do it less. So is this a primary property or is it an investment property?
well, a primary.
Okay, so on primary, that is the section 121, and that's an actual exclusion. So if he lives in it for 2 years, then he won't have to pay taxes on what he gains, up to 250,000 if you're single, or 500,000 if you're married. But if he doesn't live in it for 2 years, then he would be paying taxes on it. And so you can't do a 1031 on a primary.
Oh, so just investment properties.
Sometimes second homes will qualify, and we'll talk about when second homes qualify. It's just for business purposes, so it has to be something that's an investment property to be able to do this. And then we'll talk about the 1031 or the 121 exclusion too, which is for primary. So good question. Okay, so taxpayers who hold real estate as an inventory or purchase for resale flips are considered dealers. These don't qualify. So flippers can't, or a builder can't just build a house and then flip it into another and flip their profit and keep flipping their profit and not pay taxes. So builders aren't going to qualify. Now, if they have, though, a property that they've used and rented out, they could 1031 that specific property, but their inventory, they can't 1031. So that's just, you know, don't tell a builder that they can 1031 all their properties. Personal use property will not qualify. We just talked about that. So Barb, your question, isn't that a one-time exemption? So it's not, if you get an exemption and buy a new house, a new primary house, and then you live in that one for 2 years and sell it, you can exclude again. But you do have to live in it for 2 years. And it, you know, let's say that you lived in a house for 2 years and you moved out of it for a year and lived in one of your rental properties for some reason, and then you move back to the house, or let's say you just move out after 2 years, but you don't sell it and you rent it out for 2 years, you could still do the primary exclusion because it's 2 out of the last 5 years. So as long as you lived in it 2 out of the last 5 years. To elect the 1031 recognition, a taxpayer must, so we're gonna just go over the basics and then we'll kind of go into depth. You have to identify a property for exchange. Don't ever, if somebody wants to do a 1031, don't ever let them sell their property before they identify the other properties and before they talk to a qualified intermediary, because then they won't be able to do it. And I had one of our 1031 exchange ladies, she told me that sometimes they will call her as the qualified intermediary while they're sitting at the closing table. And she said, please don't do that. It makes it really, really hard. It can be done, but you want to, and sometimes people don't know. She said, sometimes people are like, wait, yeah, I really do want to do the 1031. So, but try to have that conversation before, maybe when you're sitting down to do a listing, is this an investment property? I don't know how you guys do it, but are you wanting to do a 1031 so that you know up front as the seller's agent too? Identify the replacement property within 45 days. We'll talk about that. Acquire the replacement property within 180 days of closing. And we'll talk about the qualified intermediary, how to pick one, why it's so important to choose a good one. And so that's really important. And there aren't rules about qualified intermediaries. So that's why it's super important to know one that's accredited, that's been around for a long time, that is going to be safe with your money, because that's the person that's going to hold the money in trust, and you can't get your money back. There's certain times when you can after you put it in trust, even if you decide not to do the 1031 exchange. So here's just some basic steps. An initial listing appointment, are you considering selling this? Like we talked about, it's going to be a 1031 exchange. Get them to a QI before they sell. The sooner the better. List on the MLS property is being sold as a 1031 and disclose that. I had somebody ask, why does that matter? Why does it even matter to have a 1031 in your documents? Why do you want the buyer to sign a 1031 agreement? Says they will cooperate. Any thoughts on that? You guys ever had any problems with the 1031? Do you feel like it complicates the transaction?
This was actually a question I was going to bring to you, Eden. So I'm glad that you're going over this exact thing.
Okay, so yeah, I don't feel like they complicate it. The only reason why you want the buyer to sign that before is because if you get closer to the end and you need some sort of cooperation or something, you don't want them to be holding that over you when you need them to cooperate a little bit. So I think it's a good idea to always have that signed, and then you don't have the chance of them using that as leverage for some reason. But I've never seen it really complicate things. It's really the sellers who have all the responsibility to figure out what their next property is and make sure their deadlines are hit and all that kind of stuff. So that because really if it closes before that, before they've identified or before they've gone to a qualified intermediary, it's on them. It really doesn't hurt the transaction. They'll just owe taxes. So
Eden, can
go
I
ahead.
mention two things real quick?
Yes, please.
I see two things there. Number one, it can be used as a contingency, either for seller or buyer, And then number two is, I think I've always thought of it as just a good trigger for title, so everyone's on the same page to know that there is an intermediary involved and to kind of watch for that type of a situation. So I have always seen it that way, and I'm sure there's more ways to see it, but kind of the trigger point for title and also it can be used as a contingency, actually.
Yes. Yeah. I appreciate that. Yeah. So title, that is a good point, that it helps title see it because they get all the rep C and stuff, and that'll help them know that they've got to contact those other people so that they're not getting that at the last second. Good point. Thanks, Rosa. Make sure the
What's a
seller.
QI?
Go ahead, Kelly.
What's a QI on number 2?
Yeah, so the QI is the qualified intermediary. So that's the person who's going to help with the transaction. That's the person that's in charge of all the money for the 1031. And so there's lots of them out there. First American has a really good 1031 group. And then also Meridian Title has a really good group. But you want to just make sure that you know who we'll talk about that a little bit, but how to pick a good qualified intermediary, but it's just the name that they call the person who's in charge of the funds, because the seller can't hold any of the funds. So they can't release, title can't release to them, and the qualified intermediary can't release any of the money to them, or they'll get taxed. So they hold it there waiting for the next transaction to fund and put that money towards that next transaction. And that's required to be able to be a 1031 exchange and have the IRS not come back and make you pay taxes on it.
So kind of like the escrow officer, but in a more specialized way.
Yes. So similar to that idea, only just for 1031s.
Okay.
Yep.
Thanks.
So they're in between title and the person who has that money, because the title company is separate too. And like First American has their own exchange division, so they're separate from the title company, and that's important. So make sure the seller doesn't touch any of the money. I mean, just knowing that the seller can't touch any money, they can't pull that money out, use it, and then put it back in, those kinds of things that sometimes people are like, hey, it's my money. Well, it is. If you want to pay taxes on it, you can pull out whatever you want. So make sure the entity that sells is the same as the entity that purchases. So you want to make sure that they're selling it in their name. If they're a sole owner in an LLC, that's fine. But if they're not, like partnerships can get a little bit tricky. You can't 1031 a share of the partnership. So be careful if you're dealing with partnerships or businesses. Make sure that, again, that they're talking to their qualified intermediary. Make sure that they're talking to their CPA too, because you're not a licensed CPA. I'm not a licensed CPA. Always going to recommend they talk to their CPA about the tax advantages and disadvantages before they make their decisions. Real estate to real estate, again, that's very broad. Like kind is very broad. Investment to investment, possibly second homes by equal or greater value. And we'll talk about some examples. So, you know, if you don't want to pay any taxes, then you're going to want to buy equal or greater value, and you're going to want to have a loan that's the same amount or more as the previous loan. Identify within 45 days. There's 3 rules that go along with that we'll talk about. There's this three property rule, 200% rule, and 95% rule. Acquire a new property within the 180 days. Sometimes it's before the next tax return, whatever's shorter. So we'll talk about that. And take the cost into account. So a 1031 exchange isn't super expensive. The lady told me around $1,000. Talk just briefly about reverse exchanges. Those are a lot more expensive, where you sell the property first, where you acquire the new property first, sorry, before you sell. And that could be something that people want to do in the really, in like a marketed, 2020, when it was super crazy. They're worried they're not going to be able to find their property. And so before they sell, they're going to buy that property first. But it's about $10,000, she said, for the reverse one. But in light of paying taxes, it could be worth it. So, okay, there's some common misconceptions. Oh, Barb said you mentioned shares can't 1031. Can one person of a joint ownership? No, so that would be a share. So like if you have a partnership and one person wants to 1031 their portion of it, that doesn't work. So I always say, like, get with your 1031 QI person before you even list your house and figure out how you can make that work. Because there's a chance you could figure out some ways if only one person wants to 1031. And there may be some ways that you could take that out of the partnership and then have an agreement or something. But yeah, make sure you talk to a QI. 1031 is not a loophole. Some people think of it as a loophole. It's not a loophole. It's a legitimate way to defer gains. Some people think of it as like you have to swap the property. So I'm deeding the property to you and you're deeding my property. I'm deeding my property to you and you're deeding your property to me. Like we're swapping these properties. It's not that either, because you could exchange one property for 10 or 10 properties for 1, or, like you can do lots of different things. So it's not just a straight swap. Some people think of exchanges as a new thing. They've been around for a long time. 1031 was adopted in 1921. Anyways, it's changed and they add things over the years, but it's not a new thing. One thing that I went to a training on, and they said that they've talked a lot about doing away with that basis up when you die in inheritance, but it's still there. So we may see that in the future, that they don't like that. But for now it's there. Definition of like kind means similar and related service or use. So again, it can be lots of different things. You can, get rid of a house and buy an apartment complex. You can get rid of an apartment complex and buy a bunch of smaller townhomes. You can buy an office space, even like a 30-year lease. As long as it's 30 years, can be deeded or can be used. So be careful on the lease ones, but there are some commercial leases that qualify as well. People think of this as only for the large investments or for the wealthy. But anybody who has an investment property and wants to sell it and buy a different one would benefit by using a 1031 exchange. People think it complicates the transaction, but like we said, we have, it typically doesn't, and we don't usually have any problems with it. Expensive, it's not really that expensive, right? So $1,000 versus paying gains on $200,000. And we'll talk about those percentages is, I mean, we're gonna do that all day long. Okay, any questions, anything else that you guys have thought? Where did my cursor go? Yeah, anyway, so
Hey,
feel free to
Eden.
unmute because I just start talking. Go ahead, Joseph.
Eden, just a quick question for you. You mentioned briefly stepped up basis. Are you going to cover that a little bit later
Yeah.
on?
Yep,
Okay.
I'll explain basis, I'll explain boot, lots of other things, and we'll have some slides to show you exactly what that is. But if I don't cover what you're thinking of, let me know.
Thank you.
Okay, there's lots of benefits. We've kind of talked about some of them: immediate tax deferral, greater buying power or leverage. You can start buying bigger and bigger properties as you push your gains and your equity. Anyway, increases your cash income and your cash flow, diversification or consolidation, relocation. So, for example, like Kelly was saying, let's say that you have an investment property in Utah, but you want it to be in California. You can defer to different states. The only thing you have to be careful about or just understand is there are a few states, and we'll talk about those, that claw back their state taxes. And so if you do end up selling eventually, you may have to pay multiple states back their taxes. So just that's a good thing to just understand that could happen, so you're not shocked. Okay. Let's see. So when is it too late for a 1031? Does anybody know?
After 45 days?
Okay, so that's a good guess because you have to, there is a 45-day, sorry, my voice. You have to pick your new properties within 45 days of the sale of the other property. If you're sitting at the closing table and you sign those papers on that house and you don't have a qualified intermediary and you haven't set it up, it's too late. There's nothing you can do, right? So, so be super careful that if you're doing a 1031 exchange, you're planning ahead before you even list the property, maybe, right? Looking at other properties, trying to figure out which properties you might want to buy. So it's once the property has been conveyed to the buyer, the opportunity to exchange is lost. If you call your qualified intermediary from the closing table, you can usually still make it work, but don't do that. If the funds have been received by the taxpayer, it cannot be unwound. So again, if the title company, you close and the title company gives you your money, then there's no way to unwind it. It's just done. Let's talk just a little bit about capital gains. This goes towards the basis and kind of gives us a little bit of a building point to talk about basis too. A capital gain is a profit that results from the sale of a capital asset, such as stocks, bond, or real estate. So you could have a capital gain for other reasons besides just selling a property, right? You have stocks that you can sell and have a capital gain on those, bonds. These flippers, they have capital gains that they can't defer, right? So they'll have capital gains on their tax return. If they flip a house and make $100,000, they're going to pay taxes on that. So that's just the gain. It's just what you make beyond what you paid for the property. Now, anybody know what else goes into the basis? So if you buy a property for $100,000, let's say, and you sell it for $200,000, then that's a really simple, my capital gains is $100,000. But what else could go into your basis that might change your capital gains?
Can't you deduct costs like fixing it up and whatnot?
Yeah, good. Okay, Julie, and I said improvements. So that's what I call improvements. What about expenses? What's the difference between improvements and expenses? So if you replace the roof, is that an improvement or an expense?
Improvement? Isn't like an expense more like an HOA fee or mortgage or whatever?
Or changing the filters or changing the furnace or like upkeep, things that aren't going to last for a long time.
Expense,
Sorry, what?
expense, wouldn't it be?
Yeah, so those are gonna be expenses, right? The big improvement, you add a bathroom, or you add another whole room, or you know, those are gonna be improvements, something that makes the property worth more. But just fixing the walls when there's a hole, or those kind of things are gonna be expenses that are just incurred with the business, so different than an actual improvement. So though you need to keep track of those separately, because and Barb says one is a long time write-off, the other is usually a one-time. Yeah, so expenses on your taxes, you're going to be able to just do that all at once. And the improvements, you're going to depreciate over time. That's a good way to remember those, but those are going to be different. So the sold price minus the basis equals your capital gain, like I said. So you sell it for 200,000, you bought it for 100,000, your capital gain is 100. Okay, but the basis, you add in those improvements and you subtract depreciation. So anybody want to try to explain depreciation? Why do we add it back into your income when we do self-employed taxes? We talk about depreciation a lot, but it's kind of this vague thing sometimes for people, right? Like, what is this? Joseph, you wanna take a stab?
Depreciation is just basically, it's an accounting opportunity for us to, create an accounting loss on our property, which actually defers tax to us as we hold properties. So basically what they're saying is the useful life of your property, if it's a, residential, they basically take the value of the property minus the land, and over 27.5 years, they divide out what the value of the home is, and you can deduct that much each year against the home in terms of depreciation. And like I said, it's just an accounting issue to basically offset some of the costs and create a book loss for you to save some tax, more or less.
Right, so this book loss is kind of what, like, it's not a loss on a physical loss, it's a loss on paper, right?
Right.
Basically, right, and so that's why it makes sense to add that back in, right? Or subtract it, they say subtract it from your basis, right? Because whatever, like, you're gonna pay taxes on whatever you've depreciated. And so when you sell it, that comes away from your basis and adds value because you've already depreciated that. But it was just on paper. So like a self-employed person that depreciated, $100,000 of assets, we can add that back in. It wasn't an actual money amount that went out of his business. And so he made more than it looks like because he has that depreciation. So that's how I like to look at depreciation. It's on paper. It wasn't actual physical cost. And so that's why you add that back in. Does that make sense? Any questions on that? So you're always going to pay taxes on depreciation, and it's usually whether you took it or not. So don't let yourself not take the deduction for depreciation, because the IRS will assume that you took it, and you will have to add in the depreciation whether you took it or not, most likely. So be careful with that. Make sure you're taking that depreciation deduction. Okay, so we have some other, more than capital gains tax. You'll have this capital gains tax. You have a state tax, depending on which state you're selling it in. I talked a little bit about the clawback, so be careful on those, and I'll show you which states do that in a minute. We call this Medicare tax, the Obamacare tax. So you have that, and then depreciation recapture was 25% of the total depreciation allowed or allowable. So again, be careful to be taking that because you may have to pay whether you took it or not. Short-term versus long-term gains. So Kelly, we were talking a little bit about, like, typically you have to hold, any short-term gains. Let's say you have a stock. If you hold it for 1 year or less than 1 year, then it's going to be a short-term gain. And if you hold it for longer than a year, it'll be a long-term gain. And they're different tax rates. So the longer you hold something, the less taxes you're going to pay. And look at this 15-year tax rate for individuals under. So most of us are going to fall under this. And otherwise you pay a 20%. So just notice, if you hold things with 1031 exchange, again, like I said, there's no actual rule on how long you can hold it, but we typically talk about it as holding it for 1 year. Unless you have some reason. So for instance, let's say you bought a house in a neighborhood and you thought it was going to be a great investment, but then after, 2 or 3 months, you're like, I hate this neighborhood. They're totally trashing the place. I don't like the renters that are coming here, and so I want to sell this. I don't want to deal with this anymore. So that can be explained, right? Why you didn't hold it for a year. So there, it's kind of like, the, primary, when you sign a place, when you buy a primary house and you say you're going to live in it for a year, that's what you are going to do. Let's say you get a new job and you sell it. You can still go buy a primary house, even though you didn't live in that house. So it's kind of your intent is what they're looking at there, but be careful with that. Don't try to push that if that isn't really your intent. Okay, so this, there's a rumor that as part of the healthcare bill, there's a 3.8 sales tax on the sale of a home. This is true. So, go to the next slide. My cursor is not working very good. So it began on January 1st with not a sales tax, but they call it a Medicare tax. Many people won't have to pay this tax because if you make under 200,000 or married couples under 250, then you don't have to pay it. So it depends on your income. State tax on gains, tax rates vary from state to state. So just be aware that your states are going to want their share. And there's just a few that do the clawback. So if you sell them and rotate it around, they're going to want their share. There's just a few there. Oregon, California, Montana. Is that Montana? Maine, maybe? Oh. Okay.
MT is
MT is what? That's funny that I can't think of that right now.
MT
Yeah,
is Montana
Okay, that's
Yeah.
what I said.
and MA is Massachusetts.
What's Maine? MN?
ME.
ME. How do you know all that?
I don't know.
Okay. Okay, so taxable sale equals a high tax burden, portion of the investment lost or unrecoverable. Thus, 1031 exchange can be super helpful, tax deferred, fully leverage your investment equity to create more wealth and more buying power. So let's talk about boot. Anybody know what boot is? You've heard that term before? So anything that you have to pay taxes on is boot in a 1031 exchange. And people could decide, okay, I made $200,000 and I'm only I want to keep 50
We
of it.
can't hear you, Eden.
You can't hear me?
No,
Anybody else having trouble hearing me?
I can hear you just fine.
You're good.
Oh, that's
Sorry,
so
Kelly.
weird. Just now I can hear you, but I saw your lips moving and I couldn't hear you. So
Oh, I'm sorry.
that's okay.
I don't know. I apologize. Yeah, so you could decide that you want to keep some of that money out. And then if you don't understand the rules or you don't have a good QI, they may make it so that you have to pay some taxes. That's another reason to make sure, but it's just the part you get taxed on. I don't know why they call it boot. Somebody said the part that gets kicked out. Maybe that's where that boot came from, but anyway, let's just kind of look at different ways that you can create boot. You want to buy something that's equal or greater value. If you buy something that's less expensive, you can, but you're going to pay taxes on some of it. So equal or greater value and then equal or greater equity. You can, again, keep some of your equity out and pay taxes on it if you need that money. But you also with your mortgage, they call it mortgage boot. If you have $100,000 mortgage, you need to have at least $100,000 mortgage or more, or you're going to pay boot too. So the new mortgage, everything has to kind of be equal if you don't want to have to pay. So here's this one, exchanging equal value for equal equity. You have the relinquished property, the property you're getting rid of, the value is 300,000. You sold it for 300,000. You're going to buy a replacement property for equal or greater. This one, in this case, it's equal. Another property for 300,000. Your loan amount's 100. Your new loan amount's 100. Your equity down is 200. Your equity down is 200. So you're not going to have any boot in that situation. If you exchange equal value but reduced equity, so you see 300 for 300, you've got the equal value. Your loan is higher. So that's fine, right? But then your down payment's only 150. So they kept 50,000 and you're gonna be taxed on that. It's called boot. Okay, so same here, your loan is 0 and they're gonna call it mortgage boot, right? Which seems weird to me in some ways, and this one's a little bit harder for my mind to wrap around. Again, why you need a good CPA and a good QI, but your loan has to be in too, or they'll call it mortgage boot. And so, how would this even happen? Maybe they put $100,000 of their own cash into it. But again, that's not what's required for the 1030 exchange. Okay, so we talked a little bit about a qualified intermediary, but the final Treasury Regulations 1991 defined the role of a QI. The QI's function is to work within the procedural restrictions of the IRC, okay, Internal Revenue Code. QI may not be the taxpayer or a disqualified person. So, and we'll talk about what disqualifies people. There must be a written exchange agreement. You need to sign something with your qualified intermediary, and we'll talk about some problems that have happened with exchange companies over the years. There must be strict control of the funds while they're on deposit. And that's what the QI is going to do and the company is going to do is hold those funds independent. Once set up with a QI, you can't change. So you can't, this isn't something you would just sign with the QI and then you go, I don't like you, I'm going to change. So once you're signed up, you're kind of stuck there with them. Let's talk just about a little bit about why it's so important to pick a good qualified intermediary. There's a few cases I'll go over where some exchange companies lost a lot of money, and why it's so important because there aren't any regulations surrounding QIs. Anybody can just decide to be a QI, and so that's a little scary to me that you just have somebody who's holding all this money. Let's say, you know, they have 10 people and they've got millions of dollars sitting there. What are they doing with that money? And so there's been some problems over the years. Southwest Exchange lost $97 million of taxpayers' money. Summit Exchange 40 million, and Land America over 400 million. And it's kind of interesting real quick to just talk about these because it's fascinating to me. But anyway, Southwest Exchange held money for real estate investors who wanted to delay federal income taxes. Federal law allows investors to use the proceeds from a property or sale to buy another piece of property while delaying gains, which 1031. Exchange became insolvent in 2007 while holding $98 million in cash for investors from 136 transactions. So this guy looted money from the company and used some of the money to buy a French breast implant maker for his public company, according to the court papers. So yeah, I don't want to deal with somebody who's going to go buy some, right? I mean, it's crazy stuff. The federal jury on Wednesday found 3 co-owners of the Summit Exchange guilty of wire fraud and money laundering conspiracy. Jury ruled that they broke the federal law when they invested clients' money into more than 100 personal real estate deals. So while that money's sitting there for 180 days, they're using it for other things, right? This one's the worst one to me, only because they had everybody in this case sign it. Their document was signed, and you know, you guys have been to lots of closings, right? There's a big stack of papers. Does everybody sit and read every single fine print in there? They almost never do, right? And oh yes, I haven't had a keyword. Let's do exchange for our first word. First word is exchange. But these guys had written into their contract that they could use the money to invest in the stock market. And so everybody had signed that saying that it was okay, even though a lot of them didn't realize it, they had signed it. And they used that, they had started investing and making money off that money while it was sitting there, but then it crashed in 2008 and they lost all that money. And there was no way for them to pay it all back. So, and the taxpayers had signed the contract, so there was no recourse for all these taxpayers. So anyway, big deal, making sure that they have a good qualified intermediary. So how do you choose it? The financial strength of a qualified intermediary. Does the QI you are dealing with have the financial backing of a larger company? Are the QI's books audited on a regular basis? These are things you can ask. What type of oversight is there to put on the QI so that they can't just take money out and use it for what they want? And does the QI have a fidelity bond or E&O insurance? So real quick, that insurance is just, fidelity bond is a form of protection that covers policyholders for losses. So you could just even write that down, and when you're doing, just make sure you ask your QI if they have a fidelity bond and errors and emissions insurance. So that just protects people. Errors and emissions insurance protects business professionals whose clients could claim damages as a result of the business professional's faulty performance. So you just want to make sure that you're protected. I always tell people, so this says, we're not Nevada, Idaho, California, Oregon, Washington, Colorado. I am licensed in some of those states, but they have specific regulations. So you want to make sure that they're compliant if you're doing that. But make sure your QI isn't disqualified by the disqualified rules. So like people who are, your title company can't be your QI, even if they do 1031 exchanges. So because like if you work with First American, because they have a separate exchange business, it's totally separate, then that you could have their title company help you and their exchange company help you. You just want to make sure everything's separate. Family members, all those kinds of things are not going to qualify. You want to make sure that they're not disqualified. Let's see. Okay, so we talked about qualified property. Everybody clear on that? Basically, real estate for real estate, land for land. It can be all any combination of lots of things. Like kind, very broad, which is nice. Single family for raw land, apartment building for retail center, office building for a warehouse, fourplex for a TIC. What does TIC mean? Tenant in common interest in an office building. So kind of like I was talking about where, you might have a 30-year lease, and sometimes those can, a 30-year lease hold interest, including options. Those will end up qualifying like a stick-built property because it's a 30-year lease. So but be careful with those ones. Make sure you're asking your qualified intermediary. Now, one thing I learned at my training, do water rights have to transfer with a property?
No.
No.
Rights
yeah.
do. Rights
Well-
do, shares don't.
Okay, but you don't have to, like, if you have water rights on one property, you don't have to buy another property with water rights.
Okay. Oh,
Right,
gotcha.
so you're right, and that's something that's super interesting. I just did a deal with water rights, and in the contract it said shares. So just water rights are part of, like, they're owned, whereas a share is like I'm renting water. So that's a good distinction. It's kind of good to know.
Well, shares of personal property and rights are pertinent to the property.
Right, so a share, though, the way I understand it is that you're leasing water. It's not like something that you own. So you call it personal property, though, because
Well, you actually can. You can get water certificates, and they're actually shares. You actually own the water. That's what shares are. And then rights are more like what you're thinking. Rights are pertinent to the property. They go along with it. You don't really own it. They just belong to the property.
Interesting. I thought it was the other way around. So I have been on the phone with the water people for hours, and we're like, wait a minute, and then she'll say things like that. And I'm like, wait, I thought I understood it. So
Yeah.
okay, appreciate it. So let's just talk about second homes real quick. There's a couple rules for second homes. The IRS has ruled that properties that are purchased for personal use, as in second homes or vacation properties, are not investment properties, and therefore do not qualify for the section 1031 treatment. Until 2008, many people were exchanging in and out of their second homes as there was little to no guidance or surrounding what did or did not constitute property held for investment. And then we had the IRS define what was acceptable. So they did make a safe harbor for second homes. And a safe harbor just means if you follow the rules, then you'll be okay. So basically, the subject property has to be owned and held by the investor for at least 24 months. So your second home has to be held for 2 years. And that's the qualifying period. The subject property was rented at fair market value, rental rates to other people for at least 14 days. But when you buy a second home, we talk about 14 days. You need to use it for personal use at least 14 days, right? You can't have a long-term rental in a second home. But now this 14 days is saying you need to have at least rented it for 14 days during each of the preceding 2 years at fair market value. So you can't just tell your family to go use it for two weeks and charge them half rent and have that count. The family can use it if they pay full market value. The investor limited his or her personal use and enjoyment of the property to no more than the greater of 14 days during each of the preceding 2 years or 10%. So this is really like, if you want to do a 1031 on a vacation home, you're only using it for that minimum 14 days. The property was actually rented out to other people during the preceding 2 years. The property should be placed on Schedule E of your tax return and reported as income. So if you're gonna want to defer that gain, you're gonna need to put the income on your taxes as well. For personal use, taxpayer or their families, anyone if rented for less than fair market value would be considered personal use. And like I said, okay to rent to family if they're paying the fair market value. If you're going to use it additional days for repairs and maintenance, meaning that it wasn't rented out, just make sure that you can show that that work was done, because the IRS will ask for that. Okay, here's the section 121 exclusion. And it is confused a lot. So exclusion meaning you don't have to pay taxes. 1031 deferred meaning you have to pay them eventually. Unless, like I said, you die and your kids inherit the increased basis. So you can kind of combine them too, and we'll talk just a little bit about that. Deals with exclusion of gain from the sale of a primary residence. So this is only primary. An unmarried individual may exclude from income up to $250,000 of gain realized from the sale of their primary residence. Married individuals can exclude up to $500,000. Taxpayer must have owned the residence for a minimum of 2 years and lived in it for 2 out of the last 5 years. Okay. So if you can possibly exclude some of the gain and defer the rest when the property starts out as a primary and then is converted to the investment, not the opposite, right? So if you turn an investment into a primary, that doesn't work. But if the personal use occurs first, you can exclude the gain under 121 and then defer the remaining. So let's say that you had a primary, turned it into an investment, and moved out of it, rented it for 2 years, then there's a possibility you could do both. So when this might be practical, working farms and ranches, bed and breakfasts, where you actually live in part of it, a duplex where you live in one part, rented out the other part, or a fourplex or triplex, significant acreage on a personal residence. Let's talk about timeframes. These are super important. You have that 45-day period, and basically the day one is when the property sells. So you have this property that you want to sell, you're going to roll it into a 1031 exchange and buy another property, and you have 45 days from when the property closes and funds until you have to identify the new property. Now, does anybody know the 3 property rule? So there's a few different ones, right? You kind of start out with the 3 property, then you have the 200%, and then you have the 95% rule. But you can do up to 3 properties. Can you do more? Yeah, we're going to talk about it. Okay, so typically we talk about 3 properties. You're going to identify 3 properties, and these are going to be 3 properties. Basically, you can change them out as many times as you want. So let's say you have 3 properties on there, and then you find another one that you like and you switch it out. You can do that as many times as you want during that 45-day period. But once the 45-day period hits, you have to buy one of those 3 properties that you identified, or you're going to pay taxes. Okay. And then once that 45-day hits, then you have to close between the earlier of 180 days or the due date of filing federal income tax returns with extensions. Okay, so I mean, really, you have as much time as you want. Just make sure you're filing extension on your federal tax return if you're trying to do an exchange in March. Okay. Because you can file extensions, till like October-ish. So that your taxes don't, if you haven't filed that extension, then you might be paying taxes. Okay. No extensions, even, that 180-day rule, there's never gonna be an extension unless it falls on a Saturday, even if it falls on a Saturday or Sunday or a legal holiday. So it doesn't matter when that 180-day, I've heard of some exceptions, like for disasters or, if there's been declared an emergency or like an actual national disaster. But don't plan on any extensions from the IRS. If you don't close on your new property within that 180-day period, you pay taxes. It's a very hard rule. Here's just an example of what the 1031 identification form might look like. I just pulled this offline. I'm sure everybody has their own version. But basically, you can see there's 3 properties right here, places for 3 properties. If identifying more than the 3 properties, please see page 2 of this document. So that's what you have, that 3 property rule. If you're just identifying 3, you're going to fall into that 3 property rule. You need to buy one of those, or you could buy all 3. So you can buy all 3 of them and kind of spread out your equity, or you can just buy one of them. That's up to you. If you want to identify more than 3 properties, then we have the 200% rule. It kind of stages. If you're doing 3 property, fine. If you want to identify more than 3, then the 200% rule comes into play. If you want to do more than that, then the 95% rule comes into play. Think about it as gradual. But like I said, you can revoke a property off the list, identify more properties. There's no limit to how many times you can add or remove properties as long as the list is finalized in 45 days.
Hey, Eden,
Yeah.
can you go back to that slide again? Do you mind going over what those 2 rules were again? The 200% rule and the 95% rule?
Yeah, I think I have a slide for them. If I don't, I'll come
Okay.
back. But I think
Okay.
I have a slide that explains them better so that you'll be able to see it. So under the 3 property rule, it's defined in this IRS code, which states that an exchanger or taxpayer executing a delayed exchange has 45 calendar days from the closing date of the sale of property to formally identify a replacement property. The exchanger may identify up to 3 properties regardless of the value, as long as he or she acquires one of the 3 as the replacement property within the 180 days. So basically, we went over that. If the taxpayer wants to identify more than 3 properties, then the 200% rule comes into play. This rule states that the identified properties aggregate value can't exceed more than 200% of the relinquished property's value. So whatever you're getting rid of, double that, and then all the properties that you're identifying can't be more than 200, twice the value. So if you're relinquishing a $300,000 property, then all the other properties that you have identified can't be more than 600,000. So the combined market value of the property or properties being exchanged cannot be more than 200% of the relinquished property. So let's say, I mean, this might come into play when you have a $20 million complex that you're selling, right? And then you're going to buy a bunch of little ones, right? You can't have it be more than $40 million. Or because I'm trying to think like, okay, if you had a $300,000 property and you were selling it, 3 properties, I mean, so maybe it might come into play more when you're going state to state, right? So let's say you sold a house here for $1 million and you bought 10 houses that were $10,000 each or $20,000 each, or, whatever. Does that make sense? Anyway, 200%. So just add up all the values of the properties that you put on there. They're more than 3, and it can't be more than 200%. Then if you want to do more than the 200%, the 95% rule says that a taxpayer can identify more than the 3 properties with a total value that is more than 200% of the relinquished property, but only if the taxpayer acquires at least 95% of the value of the properties that he identifies. So you have to acquire most of the properties you identify at the end if you're going to go past that rule. Most people are gonna stay in that 3 property rule, but it's good to know if you wanna identify more properties, then you move into the 200% rule. And if you want to identify more than 200%, you move into the 95% rule where you have to purchase those. If you can't or don't, then you're gonna pay taxes. That makes sense? Take advantage of the time frame from when the sales contract of the relinquished property is signed, so until it closes. Because that's before your 45-day starts, right? So let's say your relinquished property goes under contract, you have, let's say, 21 to 30 days before your 45 days even starts. Take advantage of that time to find your new properties and start identifying them. You could enter into a contract on a replacement property before the relinquished property closes. So, you know, you could identify those, go under contract before that property closes. It's not like you have to wait until the property closes before you can do anything. You just can't have the first property close before you close on the second property. They could have to be staggered. Even like a day, right? But they have to be staggered. So we talked a little bit about this, how long the length is not defined, the intent is key, and the IRS will look at the facts and circumstances of the transaction. When can the exchanger receive funds from their QI? Let's say you close on the house, day 0. Somebody's trying to get in. Let's do another word real quick too, because we're already halfway through. We've only done one word. Let's do QI for our second word. QI is the second word, qualified intermediary. Okay, so after the 45-day identification period, let's say you're sitting at day 45. If no property is identified, you can get your money back then. But during that time, you can't. So like you can't sign with a qualified intermediary, identify your properties, and then decide, never mind, I don't want to do this. They're gonna wait till that 45 day before they'll give you your money back. So just know that going in, so you're not like, hey, you're holding my money. That's just, they can't give it back to you. After the receipt of all the identified replacement properties, so after your 45 days again, or after the expiration of the 180-day exchange period. So once you kind of enter into this, you're kind of locked in for some time frames before they're going to be able to release your money, even if you change your mind. So this is something interesting to note, because people probably get really upset when they change their mind and they want their money back. But if a QI doesn't follow the regulations, then they could be considered an agent of the taxpayer and be disqualified as a QI. And if that were to happen, then all their previous deferments and exchanges would be called into question, and all those people could have to pay taxes. So that's why it's a big deal to them to not have any problems, and they're going to follow that rule to a T. So anybody have any questions or things I didn't go over? Oh, can you please repeat the word? The second word is QI. Oh, Rachel told everybody. Okay, thanks. Okay, any questions? Any things I didn't go over before we move on? Okay. Title parking or reverse exchanges, we're just going to go over this a little bit. So this is where you want to buy your property before you sell your previous property, right? So you're kind of doing it in backward order. And that, like I said, could happen in a market, more of a seller's market. But the QI basically takes the property to the title. Takes title to the property. So they kind of buy it. I'm hearing something. I don't know what I'm hearing. They buy that property and hold title while you're waiting for your other property to sell, so that it doesn't go into your name before you sell your first property. And it's a lot more expensive. So the lady told me it was around $10,000 for that. But that may be something that people want to do. So reasons: contingency on the relinquished property, not removed in time, no buyer for relinquished property, prevent loss of your earnest money. If you've already made a contract, because like we were talking about, you might go into contract before this property sells, or you know, and so you might be kind of in a pinch situation. Prevent loss of financing commitment, locate replacement property first in the seller's market. Okay, let's talk about kind of go through just the 5 tips for a smooth exchange. We've gone through this pretty fast. I talked fast, I guess, and we haven't had a lot of questions, but just kind of an overview of everything we talked about. Number 1, sign exchange documents before you close. You want to get with a QI immediately if you're going to do it. A 1031 exchange, find out all the things that you need to know, talk to them about all the reasons, talk to your CPA, make sure that you understand everything that you're doing. 1031 exchange rules allow you to sell your relinquished property to someone and acquire your replacement property on a later date. Exchange documents include an exchange agreement. So if you don't sign something with a QI, you're not doing a 1031 exchange. You have to sign with them. Assignment of your rights under the contract to sell the relinquished property and a notice to the buyer of the assignment. On or before you close on the purchase, you'll also need to sign an assignment of your rights under that contract, and you will need to give the seller notice of that assignment. Don't touch the money. 3 big things. Don't touch the money. Identify your replacement properties within the 45 days. And finalize your transaction within 180 days or when your taxes are due with all the extensions. So that might, like if you're coming in doing an exchange in September, then be careful, right? Because your taxes are going to be due, or make sure your taxes are filed. Your taxes are going to be due. And then you're going to have, it might crunch your time. Buy enough replacement property to defer all the gain. You don't want boot unless you really need that money and you want to pay the taxes on it. So in order to defer all the tax, you would otherwise have to pay on the gain. You must do 2 things. First, you must acquire replacement property that's equal or greater in value than the relinquished property. So if you sell something for $1 million, you must acquire replacement properties worth at least $1 million, or the deal may be partially taxed. Second, you must invest all of your net equity from the sale. If you sell something for $1 million that has a $300,000 loan on it, you must invest the full $700,000 you net out of the sale. This example ignores expenses to keep it simple. Summarize in this example, you would need to acquire replacement property for at least $1 million, invest $700,000 in cash into it, and then borrow $300,000 or invest your own funds. And then think about the expenses. There are some expenses that can be paid with the exchange proceeds that will not cause the deal to be partially taxed. And make sure you're asking about that. So some of the closing costs can be paid for with the exchange money. So make sure that you're asking about that so that you're not assuming that that exchange is going to pay for it all and then you owe some taxes. Brokerage commissions, escrow fees, exchange fees, and transfer taxes are generally considered to be this type of expense. On the other hand, when you're selling the relinquished property, if you give the buyer credit for the security deposits or prepaid rents, you are using exchange proceeds for non-exchange expenses. So again, be careful, make sure you have a good QI so they don't get caught with that. It could result in your exchange being partially taxed. For that reason, it's best to come in with your own funds to pay these if you don't want to pay any tax. Think about safety. When you do an exchange, your funds are held by the intermediary until you use them to acquire a replacement property. It's important to find out how these funds are held. Are they in a separate account? Again, make sure you're dealing with somebody who's super awesome with their money. Okay, we have a lot more slides we can go over, more just about capital gains. We still have another 30 minutes or so, but do we have any questions or examples that they want to share with us?
I just popped a question. I think there were a couple questions in chat if you want to look at that.
Thank you. What happens in a crazy market where prices are going up like last year and you end up bidding higher than the list price? That's fine, because you can buy something that's higher than what you sold it for. Doesn't have to be exactly the same, just needs to be the same or higher. Finalized means everything closed or under contract. So are you talking about the 180-day rule?
Yeah, I was just thinking, finalized, does that mean closed? Because there's circumstances sometimes out of our control that can extend that closing deadline, right?
Yeah.
So just checking to see, does that mean when everything's closed or under contract and on its way to close?
No, it has to be closed. Everything done,
Closed.
funded, done. Mhm. Yep, and they won't extend for any reason. So like, let's say your 180 days ends on a Sunday and you close on Monday, you pay taxes.
Yeah, so I have an example and a question actually. So we just had a deal where the QI had said we need to close by this date, and I said I don't think that's right. I think it's before that, and he's like, no, that's right. I was trying to close before the date, and he like was not to be seen for an entire week. Got it done by his date, and we took it to the CPA, and he's like, nope, it's too late.
Oh my
And
gosh.
so you talked about how like there can be ramifications for the QI. So we just got a bill for him, and I'm like, I don't want to pay this. He didn't do his job. So I don't know my rights on that or whatnot, but if he could potentially get ramifications, if maybe that could go down. You said he could get ramifications, right?
Well, so I said that I think you should work with somebody who has insurance because they should have insurance for cases like that when they make a mistake.
Okay.
But I don't know what you could, like, how you would get them to pay out. But yeah, definitely, if he's telling you this is the time and it's not the right time and your CPA says, nope, you passed your 180 days, or remember it's the earlier of 180 days or your tax return filing with extensions, right? And so, yeah, I definitely would look into that because I think you're paying taxes. Because the IRS doesn't say, sorry, they made a mistake. You can't say that to the IRS. As far as I know, it's a very strict 180-day rule.
The other thing that I thought was cool that my QI did, he's a 1031 exchange lawyer. Like that's who I worked with. So that's what he does. So you think that you could be confident in that. But anyways, he did show that. So we were trying to buy a place that's being built, and you know how that's going these days. So he had us buy it unfinished.
I'm assuming.
What
With
was that?
cash.
Yeah, so we put down 1031 down, and at the price of that, of what it had to have the value of what we were putting down. And it's the weird, I've never heard of it before, but I was like, look, it's getting close, like what can we do? He's like, oh, we can just have him, like the developer had to give him like what they've spent and how like to value it at what we had. And so we literally closed on a place that's not finished, and then there's documents or contracts on both ends for us to, he will finish his, we'll finish our portion of the rest of the loan when it is finished. So it's weird.
That could be, there's one that's called, it's not repairs. There is one where like you can kind of, it's like a repair exchange or something where you can roll some of the costs in, but you still have 180 days where you have to have all the repairs done. So so you started it with them and paid that money, but then it's still within the 180 days, it has to be complete, right?
No, it's still not completed, and we had finished, like we literally have our names on a like county records on this house, on this place being, that's still not even finished. Like we closed with the title company and everything.
Okay, well, I'm hoping that works out because but if he's a 1031 lawyer, I mean, I'm sure there's things that I don't know about it, but I've never heard of that. The only one I've heard of is where some things you want to do repairs to it and you still have to have those repairs done within 180 days.
Within it. Interesting.
But
Huh.
that's-
I wondered if anybody had heard of that. I hadn't.
Haven't. It's a good question. I'm keeping my fingers crossed for you. That sounds like you have a couple weird things going on. Right, with the other one, that's scary to me.
Yes.
Okay. Anybody else have any other questions that we didn't address? How are you guys feeling about the market right now? Do you feel comfortable when people come and talk to you and to say to them, now is a good time to buy? I feel really comfortable with that. I went to lunch with a real estate agent the other day and he said, how do you like me to talk to people about the market and stuff? What do you think? And how can I help when I'm talking to people that helps you? And I said, well, I just like it when real estate agents aren't so focused on the rate. Like we want to get our clients the very best rate, but right now rates are high for a lot of people and they don't like it. And it's keeping them from starting to invest and starting to pull the trigger. And so I always say, I talk about rates like date the rate, marry the house, divorce the landlord. The best thing that people can do is not rent anymore. And not everybody can do that, but if you can make it work and if you can qualify, that's the best thing that people can do in the long run for their financial well-being.
Eden, can I add to that?
Yeah, please.
So one of the things that I've been looking at too is just the simple fact that right now your affordability is less for sure. I mean, if you run numbers on $500,000 at 3.5%, that's about $2,250, principal and interest. 7%, it's about $3,350, so it's about $1,100 more. So affordability is definitely off, but equity position is definitely more positive. I live in southern Utah where, the macro, if you look at our market from a macro standpoint, it's down about 20%. And frankly, most of that's in step-up housing. It's from, 550 to 900 really. And then it's less in luxury and it's less in first, less in entry. Entry and luxury are less than that. But the reality is most people weren't even buyers last year because they were getting beat up by cash. So if you look at it from the aspect of if you can buy and you can afford it, you're probably in a $50,000 to $70,000 equity position better, even though it's more expensive. So that's where the date the rate, marry the house, divorce landlord situation comes in. So I'm learning to talk to people in terms of equity position rather than affordability if they can afford it.
That's a great idea. And for those people who can't, it is heartbreaking, right, to watch. And they
Sure.
kind of have to wait, right? Because
Totally.
it's hard to tell somebody, you just need a better job, right? Or you just need to make more money, right? But that is kind of the reality right now, right? For some people. So yeah, I agree. And I think that equity position, I had a guy who came to me, I guess he closed in January. But he really understood that. And his wife had just finished school and she got a really good job and they were making really good money, but they didn't have any down payment. And so he just said, I want to do a Utah housing loan. And I don't want to be competing with people when rates come down. And then as soon as rates come down, then I'll refinance. And he, in his mind, instead of sitting and waiting to save that money for a down payment, he was just going to put all that money that he would have been saving towards his second mortgage so that it was going to be paid off. And he got into a house with no money down. We even got his earnest money back right now because he got closing costs and he got the house he really wanted. He didn't have to compete. And he was super happy and really understood, okay, I'm going to pay a little bit more in interest right now. In the long run, I'm going to be better off. I'm going to get the house for cheaper. So let's say somebody pays, like Joe was saying, $1,100 more in interest. I mean, that's hard to swallow when you think about it that way, right? Just more interest. And then you have a lower value that you can afford too, right? But if you have this extra money that you're paying in interest, even let's say if it's $1,000 a month more in interest and you pay that per a year, $12,000 versus $50,000 of equity, I'll do that all day long.
Yeah.
So it's just kind of switching our minds to think about things a little bit different. And I also really think, rates are fairly comparable from lender to lender. And I talked to somebody the other day who said, we went with this other lender that was 1/8 of a point cheaper and we extended 4 times. And we almost lost the deal, right? I'm never going to do that. So nobody cares about the rate when it comes down to closing if you're not closing. So you just want to make sure that you're getting the very best rate you can, but also working with people who are going to get the deal done too. You're not going to have any stresses because nobody likes to be at the closing date, settlement date, and not have it clear to close. Okay, any other questions or thoughts that can help each other about the market or how to talk to people? What about if somebody comes to you and they're gonna be moving in a year and want to sell? Is now still a good time to buy for somebody like that? I'd say no, right? Short term, you're gonna be better off renting for a year than
I kind
buying.
of tell people if you have a 3 to 5 year plan, then you're probably a buyer or seller. If you're less than 2 years, then you're probably a renter. That's just kind of my personal rule of thumb, but
I like that too, but then I also like, rentals are always gonna be good, right? So if you're gonna live here for a year, but you have enough money that you're gonna be able to save for another down payment, right? You could buy for a year and then turn it into a rental.
that's a good point. Good point.
So that could happen too, but typically if you're gonna have to sell and move, then it doesn't make sense in the short term. There's lots of creativity right now with the market too. So like if you have somebody who comes to you and they can't afford something, sometimes I'll talk about, is there anybody that wants to go in on this with you? Do you have a co-signer? A lot of parents are co-signing for their kids. And I like the idea of some of these kids getting into the market because I have kids who come to me. I mean, I say kids because they're like 20 years old. They have $40,000. One girl has $40,000 in the bank and she makes $20 an hour. And she can't buy anything because she has to have, like, she qualifies for a $200,000 loan, right? She can't buy anything that she wants. But what if she has a co-signer and rents out rooms, right? Then she can still make that payment and it might be still a really good investment. So co-signers only, their credit, I mean, it's a little scary, right? And not everybody wants to be a co-signer. Not everybody can, not everybody trusts people, but some of these kids, just even to get their feet wet in the market, are going to need a little bit of help. And it only, like if I were to co-sign for my son to buy a place, it would only affect my credit and my buying power for 1 year. After he's made the payment for 12 months in a row, and when I go in to buy an investment property or something, I just show his 12 months of bank statements, make him making that payment, and it doesn't count against me anymore. Okay, that's true for cars too. I have a lot of people who have co-signers on their cars or have co-signed for kids on their cars with their moms. So if the other person's making the payment and you can prove that it comes out of their account for 12 consecutive months, the 12 previous months, then you don't have to count that payment against you. So anyway, something to think about when you're talking to people and know when they're doing that. Let's do rates for our third word. We might end just a little bit early today.
Hey, Eden, since we're talking about what we were just talking about, can you remind me how much work history someone needs in order to get approved?
Yeah, so I have this question a lot, like if somebody just started a job, that's when people usually worry the most. If they just started a job, let's say it's a salary job, sometimes we don't even need their first pay stub, and they can, if they went from salary to salary. So that's not a problem, salary is easy. But typically we ask for 2 pay stubs. So if you're full-time, go ahead.
Even if they were out of work for the last 6 months?
So that's that on FHA, they require that you be back on the job for 6 months after a 6-month.
Okay.
So that's FHA. Conventional, they don't always require that, but you'd have to go back 24 months before the break as their work history that they had a job for 24 months before that. But FHA is very strict about that. You can't pull the case number until they've been on their new job for 6 months. And FHA, you guys probably have heard this, is coming back to really compete with conventional more and more because their mortgage insurance just dropped quite significantly. So instead of paying 0.85 on mortgage insurance, they're paying 0.55. And so it's much more comparable to conventional mortgage insurance, even if you have a lower credit score, and you can get a lower rate. So FHA is looking better and better as loans for people to be able to qualify for more. So keep that in mind when even when, like are looking at FHA offers, right? So it's gonna be more competitive and more people, even with a 700 credit score, may choose to do FHA because the mortgage insurance is very similar now and they can get a lower rate. The other thing about work history that sometimes we, the problems with work history are usually when they're not full-time. So if somebody, we call it variable income, if they don't have the same paycheck, it doesn't have to be 40 hours always, like nurses work 36 hours and they're full-time. It could be even 20 hours, but if their paychecks are always 20 hours, then we may not have a problem. But anyway, if you're below 36 hours and you have pay stubs that are 36 and then 38 and then 32, that's considered variable income, and you have to have a variable income job for a year before we can even use that income. And it doesn't have to be the same job. Let's say you have a variable job for 6 months and then another variable job for 4 months and then another variable job for 2 months and you just started. We would have to go back and prove that they were all variable before we could use that income. And then they also use an average. So if somebody is on a variable job and they make $20 an hour, we would have to look at all their hours and take an average. So you don't usually qualify for as much with variable job. That's one that causes problems, and then often I'll do an income review on before I'll set pre-approval. Because if you've had problems with deals where income's cut, it's most likely because of variable job. Good questions. Okay, what are the disadvantages of owning real estate? Are there any? You have people come to these investment classes and somebody will say, yeah, but I lost my shirt, like it's not just, don't just tell people to buy houses, right? Why, what could happen when you own real estate?
You can own an Airbnb in Hawaii during COVID.
Okay, good. What else can happen? What happened during COVID when people couldn't get kicked out? One of the guys who works with us had a house and there was 13 people living in it and he wanted to sell it and he couldn't kick them out. They hadn't paid rent for 10 months. But he couldn't kick them out. Right? So it ended up working out okay for him because he held on to the house for another year and then sold it for 100,000 more in 2020. But that market is very, like, who knows when we're going to see that stuff again, right? And that's just timing the market right, like by chance. But you could have, vacancies, you could have fires, catastrophes. They're not easy to liquidate, repairs, upkeep, market downturns. There's lots of things that can happen. So as you invest in real estate, you want to be prepared. You want to have kind of an emergency fund. Some people recommend, 6 months of expenses in the bank before you really start trying to invest, or you don't want to be over leveraged. You want to be able to have money for these kinds of things so that you don't have to sell. Because when the market went down in 2008, if people could have held on to their properties that they had to liquidate, they would have made a ton of money, right? But some of them were over leveraged. I mean, we saw so many problems because people weren't prepared for problems in the market. And sometimes that just happens, but any kind of dips in the market, if you can hold on to them long term, you're going to be better off and end up making money. Okay.
Eden,
Yeah.
I just think if you're going to have investment properties, it has to be a separate business and you have to treat it like a business. I mean,
I think that's super good advice.
I think I came out of pocket $38,000 last year on some of my investment properties just for capital improvements and stuff like that. And had they not had their own account and had they not been, carrying themselves, that would have been really problematic. So
Yeah.
it does definitely need to be treated as its own separate, business entity.
Right, because sometimes you're just breaking even on paper or, as far as money, right? And
Yeah.
Can that still be a good investment if your property that you're buying just breaks even?
It definitely can when you
The
consider.
rent pays for the mortgage payment.
Yeah, it definitely can because, you get the tax advantages and you have someone else that it's funding your investment. So,
Right.
it definitely can be.
Right, but then that means, like you're saying, you need to treat it as a business and put money back into that business that's sitting there waiting in case something happens, right? And so, you know, if you're spending, yeah, definitely treat it like a business and be prepared and worry, you know, make sure that you're prepared, like you said. Because still, you're glad you have that property, even though you just put a bunch of money into them, right? Still worth it to have it, but you have to have that money there so that you're not over leveraged. Good. Let's see, there's some questions here. She's renting out rooms. Does she need to have renter contracts for the loan? So no, you would have to still qualify as a primary. This person, when I'm thinking about somebody co-signing for somebody, I'm thinking about them moving into the property and then getting a co-signer, but so that they qualify for it without any of the rents. But you know, the co-signer doesn't want to pay the payments, and so the person who bought it's going to be renting out the rooms, and they'll get lease agreements, and then they'll be able to pay the payment because of those. Does that make sense? Does that answer your question? Because the loan isn't going to allow that you to use any rents. You can do that for an investment property. That's why investment properties are easier to qualify for than primaries, because you, if they cash flow, if the mortgage, well, it's actually 75%. So I can take 75% of the rents to offset the payment, because that takes into account, you know, vacancies and all those kinds of things. So 75% of the rent can offset it. And we get the rental value from the appraiser. And that's what we use. So you don't have to have a lease agreement when you are buying an investment property. If you're moving out of a primary and using that and gonna buy another primary and turn that one into investment, then you do have to have the lease agreement to offset. You can't, we're not gonna have an appraisal to offset. You have to have a 12-month lease and first month's rent. Builder offers 0% interest for the first 3 months. The rate goes up out of the buyer's price range. We saw this happen last year. I know a friend of mine didn't qualify for her house anymore once it was finished because the rates went up so high. And nobody, I mean, I never put 3% interest pushing into my pre-approvals, right? So nobody has seen rates go up that much. And so that happened to a lot of people. This person, the builder, actually seller financed, which it's unheard of. A lot of the builders just took their earnest money from people because they could, right? I mean, you don't qualify anymore. You either have to find somebody to buy that house to get your earnest money back. But yeah, that can definitely happen. There's a builder right now that's offering seller financing at 4.99, but then you have to refinance as soon as rates come down below, I think it's below 6. Anyway, he has this written to the contract, but that makes me nervous for people because what if you don't qualify for the refinance? Even if rates come down, if you, let's say people buy, I've seen people buy cars and come back to me and want to refinance and they don't qualify anymore. So, so I don't know, but it's not edge. But yeah, it's very interesting to think about. There's a lot of people trying to move properties. So you just have to be careful when we look into these different offerings that people have. Let's do another word. How about buy, B-U-Y. Fourth keyword. So you have 4 now. And then I actually had somebody the other day, which I thought was super cool. I wanted to run this by you guys. So you know how builders, you go in, you make an offer, and builders will say, if you use my preferred lender, then you get, you know, $4,500 back or whatever. Well, one of our real estate agents said to them, well, I want to use my own lender. Will you give us the preferred incentive even if we use our own lender? And the real estate agent said, no way. And she said, well, you ask your manager. And they did, and they let him do it. I thought that was super cool. Anyway, just kind of keep a bee in your bonnet that, you know, nobody wants to use the preferred lender a lot of times. And they want you to, but somebody's making some money somewhere. And so I think that right now, when you can ask for closing costs, it's more of a buyer's market a little bit. It doesn't hurt to ask, right? If you have a lender that you really like and trust and you want to use them. So I thought that was really cool. Any other questions? I think we're going to go ahead and end. My battery on my computer's dying. It's all taped up. Maybe I need a new computer, but let's give the last keyword. Let's do seller concessions. Right now, that's a super cool thing that I feel like people should utilize, and it's part of the reason why I say right now houses are on sale, right? It's a good time to buy. So anyway, you can email, what did I say, seller concessions? So we have 5 words. We're ending just like 5 minutes early, but have a great day, you guys. I'm excited about the market. I'm excited to work with you. I appreciate that you come to my classes and participate. I really enjoy teaching them, and hopefully you feel like you can reach out to me anytime with questions or concerns, and hopefully I can help your buyers in this market, and we'll get more people doing all these wonderful things like buying houses and selling houses. So anyway, have a great weekend. Hope you're doing something fun. Hopefully this will be a good weekend. I just want it to be warm so bad. So, okay, yeah, I can send out, if you guys want the PowerPoint, when you send your 5 words, just tell me, can you send the PowerPoint, and I'll just send it to you. And we'll get these credits banked. Try to send that email as soon as you can. We usually just try to get that done today before we end. Any other last questions?
You just need the 5 words in the email. That's it, right?
Yeah, because the way that I set up the registration, you gave me your license number. So I
Yeah,
can just go
perfect.
back and get the license number there.
Wait, was there 4 or 5?
There's 5, but you only need 4. So if you have 4, just send the 4. You only needed 4 out of the 5.
Okay, because someone said one in the chat in the beginning, and then you said that exchange was the first one. So that's where I'm confused.
Oh, yeah. If you have 4, just send your 4.
Okay.
That should be
Thanks.
good. Okay. Let me know if you have any questions. Reach out anytime. I'm here to help. Have a great day.
Thank you.
Yep. See you later.